All right, let's dive in. Today, we're tackling a really popular tool that traders use to try and catch big market trends. We're going to break down how to use it the right way, and maybe more importantly, how to avoid a classic trap that gets a lot of people.
I mean, let's be real. Who doesn't want to spot the next big market move, right? That's kind of the whole game. Well, today we're looking at a tool that's designed to help you do exactly that. And yeah, there's a powerful tool out there that can help. But, and this is a big but, using it wrong is a classic trap. It trips up so many traders. Today, we're going to make sure that doesn't happen to you. Okay, so first, let's look at the dream scenario, right? We're going to walk through a picture-perfect example where all the stars align, all the signals fire correctly, and it points to a beautiful, profitable trend.
So, the two main players we're talking about here are moving averages and the MACD. Now, these guys are trend followers. They're designed to jump on a trend after it's already started. And yeah, that might mean you get in a little late, but here's the trade-off. Your chances of being flat out wrong go way down. All right, let's get our hands dirty and look at a chart. What you're seeing here is a daily chart for the British pound versus the US dollar. See those two lines? The blue one, that's your 10-day moving average, and the red one is the 20-day. Simple enough. Now, I want you to focus on what happens right around October 15th. See that? The blue line shoots up and crosses above the red line. In the trading world, we call that a bullish crossover. It's basically a big, flashing sign that says, hey, the price might be about to go up. But here's where it gets really interesting. Check out the MACD indicator down at the bottom. At pretty much the exact same time, it also makes an upward crossover. So you've got two totally different tools screaming the same thing, buy. This is the confirmation we're always hunting for. And just look at what happened next. Wow. If you jumped in on that confirmed signal, you would have ridden this gorgeous, long uptrend. We're talking about a move that could have led to some serious profits. It's just a perfect textbook setup. Okay, so that seems pretty straightforward, doesn't it? But, and there's always a but, here's the million-dollar question. What happens when the signals disagree? And that leads us right into our next part, where things get a little dangerous. We are now officially entering the fake-out zone. This is the trap we've been talking about. So what in the world is a fake-out? It's a really simple idea, but man, is it painful when it happens to you. It's when a signal, like a crossover, looks totally legit, but it's a lie. It's a false alarm that tricks you into making a bad move. So you can see what I mean. Let's pull up another chart. And just a warning, this one doesn't have such a happy ending. Okay, check out what happens here around March 15th. If you look down at the MACD, it does its thing. You get a nice, clear, bullish crossover, a classic buy signal. Now, if you were only looking at that, you'd probably be thinking, all right, time to go long. But hold on. Now look up at the main price chart. What are the moving averages doing? Nothing. Absolutely nothing. The blue line never even gets close to crossing the red one. We got zero confirmation, none. And that, my friends, is a fake out. Acting on that one lonely signal from the MACD, it would have been a big mistake. You know, the material we're pulling this from puts it pretty bluntly, and I love it. It says, if you acted on that buy signal from the MACD, you just suffered a fake out, buddy. Ouch. That's a tough lesson to learn with real money on the line. And hey, this wasn't just some random fluke. Look what happens again at the end of May. It's the same story. The MACD screams buy, but the moving averages are just sitting there silent. And what happened to the price? Yep, it went down. Total bummer, right? There is almost nothing more frustrating than seeing a signal that looks so promising turn into a losing trade. So, what's the big takeaway from all this? Well, we finally reached the most important part of this whole thing, the one single principle that can separate a great trade from a painful fake-out. And it's all about one word: confirmation. Look, it really just boils down to this. On one side, you've got the recipe for a high-confidence trade. You get a MACD signal, plus you get that moving average crossover to back it up. But on the other side, you've got the danger zone. Relying on just the MACD by itself, that's a huge gamble with a very high risk of a fake-out. So here's the absolute crucial point, the thing I really want you to remember. Don't think of the MACD as some kind of magic crystal ball. It's not. Think of it as your confirmation tool. It's that second opinion you always want before you make a big move. It's real power, it's real strength,
is when it agrees with everything else. And that pretty much wraps it up. We've seen how powerful the MACD can be for confirming a trend, and we've seen the costly trap of using it all by itself. So I'll just leave you with this one thought. Now that you know what the trap looks like, how are you going to make sure you avoid it? Thanks for tuning in.